Hello and welcome to my channel, where I share with you my insights and analysis on various investment topics. Today, I'm going to talk about an investment plan or portfolio for a recession in 2023. A recession is a period of economic decline, usually defined as 2 consecutive quarters of negative GDP growth. A recession can have many negative effects on businesses, consumers, and investors, such as lower profits, reduced spending, higher unemployment, and lower asset prices. There are many signs that a recession may be coming in 2023. One of the most reliable indicators is the yield curve, which is the difference between the interest rates on short-term and long-term government bonds. Normally, long-term bonds have higher interest rates than short-term bonds, because investors demand more compensation for lending money for longer periods of time. This is called a normal or positive yield curve. However, sometimes the yield curve can become inverted, meaning that short-term bonds have higher interest rates than long-term bonds. This indicates that investors expect lower interest rates and lower economic growth in the future. An inverted yield curve has preceded every U.S. recession since 1955. The yield curve has been inverted since July 2022, suggesting that a recession may be imminent. Another sign of a possible recession is the recent banking crisis that has shaken the financial sector. Several banks, including Silicon Valley Bank and Signature Bank, have collapsed due to risky lending practices and exposure to bad debts. The Federal Reserve has intervened to provide liquidity and prevent more bank runs, but this has raised fears of a credit crunch, meaning that banks become reluctant or unable to lend money to businesses and consumers. A credit crunch can reduce economic activity and trigger a recession. The Federal Reserve has also been raising interest rates since March 2022 to combat inflation, which reached 9% in June 2022. Higher interest rates make borrowing more expensive and can dampen demand for goods and services. However, the Fed has not been able to bring inflation down to its target rate of 2%, as prices rose 6% in February 2023 compared with the same month last year. This means that the Fed may have to raise interest rates even more, which could further slow down the economy and increase the risk of a recession. So how can you prepare for a potential recession in 2023? What kind of investment plan or portfolio should you have? Here are some general guidelines and suggestions. 1. Diversify your portfolio across different asset classes, such as stocks, bonds, cash, gold, real estate, etc. Diversification can reduce your overall risk and help you weather market volatility. 2. Reduce your exposure to cyclical sectors, such as technology, finance, consumer discretionary, etc. These sectors tend to perform well during economic expansions but suffer during recessions. Instead, increase your exposure to defensive sectors, such as healthcare, utilities, consumer staples, etc. These sectors tend to provide stable income and demand regardless of economic conditions. 3. Look for value stocks that have strong fundamentals, such as low debt, high earnings, consistent dividends, etc. Value stocks tend to be undervalued by the market and offer higher returns than growth stocks over the long term. Growth stocks tend to be overvalued by the market and rely on future expectations rather than current performance. Growth stocks may lose their appeal during recessions when investors become more risk-averse and pessimistic. 4. Consider investing in emerging markets that have higher growth potential and lower correlation with developed markets. Emerging markets may offer opportunities for diversification and higher returns than developed markets during recessions. However, emerging markets also carry higher risks, such as political instability, currency fluctuations, and regulatory uncertainty. Therefore, you should only invest a small portion of your portfolio in emerging markets and do your research before investing. 5. Hold some cash or cash equivalents in your portfolio for liquidity and safety. Cash can help you cover your living expenses and take advantage of market opportunities during recessions. Cash equivalents are short-term investments that can be easily converted into cash without losing much value, such as money market funds, treasury bills, certificates of deposit, etc. 6. Invest in gold or other precious metals as a hedge against inflation and currency devaluation. Gold tends to retain its value and increase in price during recessions when fiat currencies lose their purchasing power due to inflation or monetary policy actions. Gold also acts as a safe haven asset that attracts investors during times of uncertainty and turmoil. To illustrate these principles, here is an example of a possible portfolio for a recession in 2023. U.S. large cap value stocks 20%, U.S. small cap value stocks 10%, international developed market stocks 10%, emerging market stocks 5%, U.S. investment grade corporate bonds 15%, U.S. high yield corporate bonds 5%, U.S. Treasury bonds 15%, gold or gold ETFs 10%, real estate or REITs 5%, cash or cash equivalents 5%. Of course, this is just an example and not a recommendation. You should always consult with a financial advisor before making any investment decisions and tailor your portfolio to your own goals, risk tolerance, time horizon, and personal situation. In conclusion, a recession in 2023 is a real possibility that investors should be prepared for. By following some general guidelines and suggestions, you can recession-proof your portfolio and minimize your losses or even log some gains during a downturn. You can also position yourself to benefit from recovery when the economy rebounds. Thank you for watching this video. If you found it helpful, please like, share, subscribe, and hit the bell icon for more videos like this. Also, leave a comment below with your thoughts or questions on this topic.